share the link with all your networks. So the topics that we're going to cover here, number one is advanced capital budgeting decisions. That is topic number one. This topic normally comes in exam. Normally question number one or question number two, you will get this particular topic. That is the first topic in advanced level, FM. The second topic is called portfolio theory and analysis or portfolio management. It's also called portfolio management. It's called portfolio management. The third topic is called advanced financing decision. Advanced financing decision. Then we have mergers and acquisition, topic number 4. Topic number 5, we have corporate restructuring and reorganization. Corporate restructuring and reorganization. That is topic number 5. Topic number 6 is called financial risk management. Topic number 7 is called international financial management. International financial management. That is topic number 7. Topic number 8 is called real estate finance. Topic number 9 is called emerging issues or contemporary issues and emerging trends. Now, I just want to mention that it is important that you take the topic seriously. The topics that can never miss in exam are here. And I want you to look at the topics
The last topic is
for the
not
purpose of
physical.
revision. Come again?
Number 9 is not visible. The board is down.
Number 9 is contemporary issues and emerging trends. Now, I wanted to say that these topics are very important that you understand them for revision purposes. When you will be doing your revision, you need to remember that you cover all the topics. The topics that are mandatory in exams, topic number 1 will always be there. It is either question number 1 or question number 2. It has to come. Topic number 2 will always be there. It is normally question number 2 or 3, but mostly question number 2. Topic number 3 can be in question number 1, 2, or 3. Topic number 4 may or may not come. But it is a very important topic that when it comes, it gives you good marks. Topic number 5 can either change with topic number 4. If 4 comes, 5 can miss. But one of them always comes. Topic number 5 is very easy, but has good marks. It is mostly theory with some calculation. Calculations are 2 or 3, but good marks. Topic number 4 has got small theory, but it has calculation that requires deeper understanding. You need to understand the concept. So if you miss it during introduction, it is not easy to catch up. Topic number 6, financial risk management. A lot of questions come from this topic. It is not easy for it to miss in exams. International finance are basically theory. Topic number 7 are purely theory. That is where you'll be looking at things like the functions of the World Bank, functions of IMF or roles of IMF, African Development Bank, such like things. There are theories, but small area. It normally comes with around 5 marks or 7, if more, in exam. Inaweza kuja tu kidogo tu, right? Just to support you. But it normally comes in exam with some small marks, but it's purely theory. I'll share with you notes in advance for topic number 7. Uanze kupitia on WhatsApp. Topic number 8 is a new area. As the name goes, real estate finance, it relates to real estate. The business in real estate has been realized to be booming, and most people are now giving focus on real estate. So they want to know, how do you value real estate, the challenges in real estate. When we talk about real estate, we are talking about the land and anything affixed on it, anything that is permanently attached on it, like buildings. Those are real estate. So we might be looking at the value of real estate. You have to calculate the value of the building and the value of land on it. So that is real estate. There are questions that can come from that. This question, this topic, because it is about valuation and finance, it is normally taught together with topic number 3, which is about financing decision. So we might combine them so that we can be done with the financing, because you have to again calculate how to finance the real estate. It means that you need to know the value, then you can look at real estate financing. So it goes together with topic number 3. Now, when we be covering topic number 3, we might combine it with topic number 8. Topic number 9, contemporary issues. These are things like cryptocurrency, which I know you are aware of. You have cryptocurrency, right? So that is mostly what is there. So you need to understand. I'll share the notes again on this theory. Cryptocurrency, you need to understand what it is and the challenges that organization face when they are trying to adopt a cryptocurrency. So these are the topics that needs to be mastered. Now, topic number 1. Topic number 1 is normally a very wide topic. It can even take a whole month. Topic number 1 is very wide. It can take a whole month. It is normally around 10 lessons, between 10 to 12 lessons, topic number 1. So you need to be very keen and don't miss classes. It is the reason why we have AFM 3 lessons a week, because it is only through the 3 lessons that you can be able to cover the whole syllabus. And it is not like we are repeating. If you miss a class, you have missed it, because you are going to the next area and not coming back. Now, you need to attend all classes from the beginning, right? Topic number 2 is not very wide, but is one of the main topics in finance. You cannot do finance without understanding the portfolio management, the investment issues, the risk. You cannot. So it has to come in exam, and is set in different ways. you need to understand it well. Whether you're doing your master's or degree, this topic always there in finance management, right? It has to always be there on financial management. Topic number 3, cannot miss. One of the functions of finance manager is financing decision. So here, what we're basically trying to do is that in topic number 1, you are trying to discuss or look at a situation where you have some capital to invest, but the capitals are actually limited. So you need to budget with the limited resources that you have to get the maximum return. So when you're looking at different projects that you want to invest in, you have to budget. So then when you're budgeting, you need to make the decision that can give you the highest return with the lowest expenditures. So therefore, we shall be looking at NPV, the net present value, or the profit or return. So topic number 1 is focused on the best budget or project that can give you the highest return at the lowest cost. Topic number 2 is focused on the best project mix, which we call portfolio, that can reduce the risk of investment. If you go and buy shares in Nairobi Stock Exchange today, they are most likely that some shares will be increasing in value as others goes down. So what is the best portfolio? Portfolio are a group of C shares or securities. We shall be using the word shares or securities or assets to mean the same thing. So if I use the word asset or shares or security, it is the same thing. When you have different groups, let's say that you buy shares from Safaricom, you buy shares from Kenya Airways, those shares form a portfolio, which we call security. Now those shares needs to be shares that can give you the highest return with the lowest risk. So we shall be looking at the portfolio theory, and you need to know how to manage the portfolio. I repeat, portfolio is a group of assets. Portfolio and a group is a group of assets. And the reason why we normally make portfolios so that we can be able to reduce risk, and get the highest return. So it is important that you attend this class. It will take you, like I said, that the first one can go to 10 lessons, 10 to 12 lessons, the first one. The second one can be around 6 to 7 lessons. And the third one can be 8 to 9 lessons. The rest can be 2 to 3 lessons and you're done. So that means that if you miss the first 3, you will be in a very bad position to catch up. So. Now, these are the topics that we need to cover. Yvonne and Alex, welcome. These are the topics that we shall cover. My name is CPA Dennis. I'll be taking you through AFM the whole semester. So let me wrap so that we can start introduction. Topic number 1. Topic number 1 is very important. It will take us 3 to 4 weeks. So please don't miss classes. 3 to 4 weeks, because it is around 12 lessons or 11. And in some cases, I might call you for a makeup. When I have an opportunity, maybe there is a holiday or some weekends, I might request you to come when studio is free for a class, a makeup class. Kindly avail yourself. If you have any other business, forget about them until end of April. Those weddings, those birthdays, parties, you'll have to reduce them because we have to push the syllabus to end so that we can do some revisions. Thanks so much, Ruth. Now, let's start with the topic number 1, that is advanced capital budgeting. Remember what I said. One of the challenges that we have as finance managers are the limited resources that we have. We have very few resources, but we need to have investment that can give us a better return. So you need to invest a small amount of money, but you need to get a better return because you don't have much. Resources are always limited. So we have to make a decision on how to budget with the resources that we have. Now, in this particular topic, the areas that we're going to cover in this topic are like, number one, we shall look at simulation analysis. These topics, you must understand them because the examiner can bring them in questions and in exams. You need to ask yourself, do you even know where the question has been set from? Most students will tell me after exams that, Mwalimu, I didn't even know AFM inanichanganya. Hata sijui topic gani wana set. And in some cases, they can even mix topic 1 and topic 2, they set together. So you need to know that the question has come from topic 1, subtopic 1 or subtopic 2. You need to know exactly where the question has come from to be able to apply it. FM has got quite a number of formulas, but if you are able to understand them well, you'll not have a problem tackling the unit. So the first one here is called simulation analysis. To simulate is to copy a trend, So I know that you guys do this when you are budgeting. You always, every end of month, you always budget and say that last month, the price of unga was 200. Right now, it can be 210. You copy something that has happened somewhere else, you are trying to estimate. So when you are budgeting, you always ask yourself, what could be the price? What could be the variables? What is the possibility that price has gone up or down? That one we do when we are budgeting every time. So again, we are using simulation here. We are going to copy certain trends to want to predict what we can get if we invest. So you can say that in my last investment, when, for example, you want to plant sugarcane, you always say that, I think the last time I bought 1 acre of land, I spent maybe 20,000 or 50,000. On top of that, there was seedling cost, there were applying cost, and all that. Then you add total. That is the total cost of investment, all right? Then you now want to replicate that today. That now, if I'm going to invest, probably the cost has gone up because of the duration. So you're using probability that could be the prices are quite or a little bit higher, right? So that is copying trend of what has happened before. You are trying to bring that cost here. You also estimate the revenue. You even work and estimate the profit before you go to the actual investment. That is simulation. We shall be able to use that probability and look at that. The next one, after simulation, we shall look at sensitivity analysis. This is a very important thing. Most students always get confused. Exam imebaki 2 weeks na haelewi what sensitivity analysis is. You cannot do advanced capital budgeting without understanding sensitivity analysis. Now, sensitivity analysis, from the word sensitive, it means that it is vulnerable to some changes. If somebody says that your hand is sensitive or your face is sensitive, it means that if you use any water that you are not used to, or any soap, or maybe you have used some oil, it can actually behave to some in a certain way, right? So we are asking ourselves, as we plan to budget, we can ask ourselves, what if the costs have gone up? What will be the implication on our profit? So how sensitive is your profit on the cost? Because when you are budgeting for investment, you always think about the possible profit. But what if scenario? What if the cost goes up? What if the prices for the goods goes down at the time when you are selling? What will be the implication on the NPV? So here, we are trying to look at how the profit will behave with a certain change on the variables. When one scenario changes, how will it implicate the price or affect the profit, right? So in sensitivity analysis, we are looking at a change on one variable when other variables remain constant. Assuming that others remain constant, what will the impact on the profit on the other variables? Now, I want to listen carefully. Normally, when we talk about NPV, I want to bring the concept of NPV in the general advanced capital budgeting. When you talk of NPV, we normally say that when you are budgeting, you have to consider the value of money. So you always say that if I'm investing today, the profit that I'll get in the next 10 years will not have the same value as it today, right? The value of money changes, si ni ukweli? The value of money changes, waziri, si ni ukweli? It is better you give me 10,000 now than giving me 10,000 in the next 5 years, because I'll not be able to buy the same thing that I would have bought today. In 1997, I know some of you are very young. 1997, nilikuwa nimezaliwa. My dad used to buy a very huge goat at 1,000. 1,000, we buy a very huge goat. And I remember we used to have some cattle. A very huge cow we will sell at 12,000. 15,000, you have a very big bull. But today, the same bull is 60,000. What has happened? We'll buy that bull at 15,000 and people will just worry, a big one. But today, even a small size compared to that one is 60,000. So it means that the value of 60,000 now is equivalent to the value of 15,000 some 25 years ago or 30 years ago. So the value of money goes down. Because of that, if you want to pay me in the future, you need to discount it. I need to ask myself, that profit that you're going to get me or give me in the next 5 years, what is its equivalent today? What is its equivalent today? So we are going to use what is called discounting. So we are going to use what is called discounting so that we get the value of what we are expecting in the future, we get its value today. So, you know compounding, that one you know, compounding. Compounding is when you move from now into the future. This is the formula, or it is a method of calculating, the future value. The future value of anything, you have the principal today times 1 over into R. That is compounding. Discounting, this one is giving us the future value. But if we know the future value, we want to know its current value, which is now the present value. So we have present value is equal to the future value over R plus R, which we can say now it is the future value into 1 plus R raised to negative n. That is now called discounting. We are coming from the future to the present. The future to the present. Because I know that value you are going to give me in the future, it is not the same as the one for today. However, my investment I'm placing now, if I'm investing 1 million now, you can't tell me that it's going to give me 10 million in the future. No. Tell me it's equivalent today, because hata mimi natoa hiyo pesa leo, na invest leo. Kwa hivyo niambie the equivalent profit that I'm going to get today. And that's where we are coming up with the NPV. We are trying to discount the future cash flows to bring it to today's equivalent. Therefore, we have cash flows that are regular and we have irregular cash flows. Cash flows are the monies that you're going to get in the future. The money that you're going to get in the future are future cash flows. Those cash flows are always written as CF, or future cash flows, or cash flows in the future. Now that cash flow is in the future, but if I want its equivalent today, I now discount. When I'm discounting, I'm going to use what is called present value of interest factor, or interest factor of the present value. So we call it, we multiply that future peak value with present value interest factor. So we need a discounting figure. We are discounting it. We are bringing it from future to current present value. We agree that I'm going to get revenue in the future. Fine. We want to know its equivalent today. If I were to get it today, so I take that future value, I discount it by a certain figure, which we call present value interest factor, so that I can get its equivalent today. That one is called the present value. That figure that I'm going to get as the present value, it can be net. I can now call it net present value. If I take the figure that I'm going to get, which is the CF times the PV bar or PV minus the amount of investment, which we call initial outlay. the initial amount that you are outlaying, the initial cost of investment. When I subtract that, it now makes it net. But then, if the future cash flows were the same as the total revenue that I'm going to get in the future, revenue minus cost is equal to profit. So this is the future cash flows. This is the revenue that I'm going to get in the future. If I subtract the cost of investment, I'm getting the profit. Therefore, to some extent, we might equate or we might compare the NPV to profit, but it's the profit in the future. So as we proceed, if it happens that I refer to NPV as the profit, or I call profit NPV, you should know the relationship. The only thing is that NPV has been discounted. It is the future cash flows that have been discounted. Today, the reason why we are discounting, because we want to get its equivalent value today, because even the outflow is also being released today. We are releasing the money or investing today. So we cannot compare the future value with the current amount. We need to bring them to their equivalent value today and then subtract. Then we can ask ourselves whether there is profit or not. Thank you so much. Now, if that is understood, then now it means that we have three things here. We have profit, we have the cost, and the revenue. So in sensitivity, we are trying to ask ourselves, how sensitive is the profit when we vary the cost? How sensitive is the profit when we vary the revenue, right? When you talk about the cost, there are two costs. There is the initial cost of investment, and then there is the current cost of running the business. Those are two costs. Initial cost of investment is the amount that you are pumping or buying the machinery. If today I was to buy laptop or computer, the cost of buying computer is the initial cost, but the cost of maintaining the computer is the running cost. So we have two types of cost, which we have to consider. We have two types of costs which must be considered. Are we together? Now, there are two types of sensitivity analysis. We have two types of sensitivity analysis. The first one is called impact analysis. Under impact analysis, we will be given a percentage of variables in advance. Percentage of variables is given in advance. They will tell you that one item varies by 10%. The cost has gone up by 10%. They will tell you how the item varies with what percentage. So they will tell you what percentage has it reduced or increased. Then you now calculate the implication on the revenue, and we shall be able to see that. The second one is called break-even point sensitivity analysis. In this one, percentage of variable is not given. Or percentage of variation. Let me just call it percentage of variation. The percentage of variation is not given. Those are the difference between the two. So in this one, they will tell you the percentage of change. They are telling you that, for example, you can be told that the profit is equal to, normally profit in a quarter, profit is revenue per unit minus cost per unit times the number of quantity minus the fixed cost. Clear? That is profit. Cost per unit minus, no, revenue per unit minus cost per unit times the quantity minus fixed cost. Of course, this is profit. Now, under impact analysis, you will be told that there was a percentage increase in cost or revenue. They will give you the change. So they are asking you, what will be the profit? What will be the NPV? What will be the NPV if there was a 10% increase in revenue? How will NPV behave? How sensitive is the NPV? But under break-even point, they will not tell you that. In break-even point, we are looking at the amount or the amount of change or the amount of these ones, the variables that will make NPV 0. The word break-even means that we are not making profit and we are not making losses. Sindio? In your business, when you say that you are at break-even, that means that you are at a point where you are neither making profits or losses. Sindio kweli? So at that point, profit is 0. Profit is 0. It means that revenue and cost are the same. The total cost and total revenue is the same. You're not making profit, and you cannot say that you're making losses. Therefore, at that point, our break-even point, the NPV is 0. Because NPV is the same as profit, we have seen, it's 0. So at break-even point, NPV is 0. We shall be able to say, to check the changes, the amount of changes that will make NPV 0. So I hope that you understand that. Let's come back to number 3 here. We've talked about sensitivity analysis. So number 3, we are looking at scenario analysis. Scenario analysis. Scenario analysis is something that you have also done. You know, some of these things are practical. When you are investing, you always say something that, what if the condition changes? Wakati unaona we are close to election, people don't invest because we expect economy not to do well. So we normally say, if I invest here and the economy fails, what will happen? If I invest here and the economy does well, what will happen? So here we are looking at different scenarios, and we have 3 conditions. We have the normal scenario, which we call the base scenario or base condition. And then we have the boom when economy is doing well, and then we have depression. So we have to compare that. And of course, we use probability when we are comparing that. There is a possibility the economy can do well or do badly, or the economy will be normal as expected. So we are looking at those particular scenarios, and we shall be able to look at that. The worst condition, the base condition, and the best condition. So we have the normal condition, we call it base. And then we have worst. And then we have best. So you'll ask yourself, what if I invest and then we realize a worst condition? What if it is base condition or best condition? We shall look at that. That is scenario analysis. And remember, each of these will take 1 lesson. Sio rahisi, sio kitu unakuja tu unamaliza hivi. So it means that already in topic number 1, we shall have done 3 lessons. Or even 4, because this can be 1 and this can be 1. So those are 4 lessons. Lesson 1, lesson 2, lesson 3, lesson 4, lesson 5. Yeah, 1, 2, 3, 4. 4 lessons, right? So 4 lessons, those are how many weeks? Almost 2 weeks. Hatujatoka topic 1. Then we have number 4, certainty equivalent coefficient. Certainty equivalent coefficient, we also call it SEC. SEC, certainty equivalent coefficient. Now again, sometimes students surprises me. We are almost doing exam, and then I tell them, make sure that you revise certainty equivalent coefficient. Anakuuliza, hiyo ni nini? Hajaisikia na tumebaki na 1 week. So we are saying that sometimes when you are investing, there is something that you think, and then there is reality on the ground. Like there is a time I was involved in a business. I wanted to try business here, matatu. And so a friend of mine was telling me that, you know, Dennis, you can do matatu business, ikona pesa. So you're being told that every day, you go and buy matatu at 2 million. Go and buy matatu at 2 million. After buying matatu at 2 million, you come and put it on the road. Every day it is going to give you how much? 3,000 per day. So 3,000 per day, that is somebody telling me, somebody who doesn't understand finance, doesn't understand risk, doesn't understand certainty. 3,000 per day times 30 days in a month, average. Mimi naona hiyo ni pesa mingi sana, sio? Hiyo ni 90,000. 90,000 per month. Gari inaniletea. That 90,000 times 12 months, it is coming to 108, right? 108. That is 1 year. 1 year. Alafu, in the next 2 years, I should be having 2 point. I believe it is like that. So to my mind, I'm saying that this is a good thing. Only after 2 years, I've recovered my money. Even if I was to pay loan, I take loan here 5 years, I will pay that loan within 2 years. Hiyo ni biashara mzuri. That is what that person was telling me. And I'm buying the idea. I'm thinking of taking loan to do that. But that is just his thinking. That is not certain. It's not certain. When you come to the ground, the reality is different. When you buy the matatu at this 2 million, you'll realize that there are a lot of things that you're going to put in it that can even push it to 3 million. After doing that, on the road, we have insurance that you have to renew. We have to pay driver. Probably, this one is a network. We have to pay police. So at the end of the day, that money is not certain. You might not even get 90. You might even get 50,000. So what we are saying is what we are thinking of, but not what we are sure of. Now, in investment, there are probability that you can get what you are saying or not. What makes it vary is the level of risk that can come. Now, when we have some risk element, then we are talking about imagination. We are not talking about something that is certain. When we remove the risk element, the balance that you're going to remain with is now the certain amount, the amount that you are sure of after taking away the risk. But then, what are some of these risks? One of the risks here is the inflation. Another risk, interest rates. Another risk, political instability. Those kind of risks need to be taken care of. Now, in this case, we are talking about a situation where inflation can affect it. So we have cash flow, which is overstated, but we didn't take care of inflation in it. That cash flow with the inflation is not the real cash flow, because inflation is risky, is risk. The real cash flow is now the cash flow that you can estimate without risk at all. That kind of cash flow that is real without risk, we call it certainty equivalent. So if you are able to predict this, then you say that what is the probability that you can get your cash flow? What is the probability that you can get this money? Is only 70%. 30% can go to risk. We are only 60% sure or 30% sure. That percentage of surety, it is a percentage of certainty. We call it certainty equivalent or certainty coefficient. So if, for example, I want to say that I've estimated my rental income, and I'm saying that my rental income is that in year 1, I'll be getting like 2 million or 20,000. Let me say 200. That is a better amount. That is just cash flow. After all the expenditures, I'm thinking of 20,000. Another year, 30 or 300, sorry. Then the last year, which is the third year, maybe 250. You see, I'm assuming that all my rooms, the houses, the units will be full. At every given time, they will be having tenants. That is my assumption. But the reality is that there is a month or even 6 months that will not have any tenant in those full rooms. You might only be 50%, it might only be 50% occupied. So therefore, this estimation is just rumors. The percentage or the certainty equivalent, which we can now call SEC, is the percentage of the truth. So it could be that in year one, the houses are still new. The percentage of you having 200,000 as you expected